The question is, what does this risk tolerance mean? So if you're a bank, you would say your risk tolerance was 99.2%. I come from the insurance side, so they express it on the other side. So it kind of depends whether you're saying, left or right can be 0.8 or 0.992, but that's what you start off with, 1 minus your risk tolerance for the table value. So you got 1 minus 0.008, which equals 0.992. 0.992 is right there. So what's the table value? 2.41. And that's the number of standard deviations. So remember your stats class, the mean's right in the middle. If you move the standard deviation is 2.4%. So if you move 2.41 times 2.4%, that should happen 0.8% of the time. You should get a number worse than that 0.8% of the time. You should get a number better than that 99.2% of the time. And then the formula, real simple formula, var equals the mean minus number of standard deviations times the standard deviation. So that's a real simple formula, which is a formula we use quite a bit. This is parametric vars. So if your firm uses parametric var, which is not that uncommon. Insurance companies typically use stochastic, but that's fine. So here the mean was given as 0. You got the 2.41. The standard deviation is 2.4%. I don't know what that is, but so it's 5.784. I did that right. 5784, excuse me, 5784. You notice I didn't put on negative signs, so we always do this in absolute because we know it's a loss. So I've never heard anyone say our bar is negative 5.8%. They're going to say our bar is 5.8%, and you know that's a loss. All right. Problem is, their budget's in dollars. So you have two choices. You can take 12 million and divide it by 175 million, or you can take 175 million times your VAR. Either one of those works. So VAR in dollars is going to equal 175 times 0.05784. This keyboard is really sticky. I think I saw someone with a number of rows similar to that, 10.12. And so what's the grade? VAR is less than the limit. So pass. And that's what you're looking for there. That look right? I saw at least 10 point something, so it looks pretty close. So it's really a fairly simple question, but also if you understand this question, the more complicated versions really aren't that much more complicated. It's a theory on a theory. The hard part of this, it's not the calculations. The hard part of it is, do you trust this number? And where did you get this number? But that's all been worked out. And once you got that, you just got to figure out, hey, does this portfolio pass or not? It's a pretty good technique. All right. So it's our last class. Let's finish up. So what I'll do, I'll put a practice exam out on Canvas here, and then I'll set up some office hours that I'll do on Zoom, maybe on Thursday, I don't know. I'll record it and I'll just work that exam. It won't be an official study day because I can't do a study class during dead days. It'll just be special office hours that you attend if you want to by Zoom. If you don't attend by Zoom, you can watch the video later. You already have one of those videos from a previous semester anyway. So I'll let y'all know once I get it all set up. And I'll explain the Excel versus the non-Excel as I'm doing that practice exam. All right, so we've been talking price risk. On price risk, we said, it's pretty straightforward. An asset price falls or liability rises, pretty straightforward. We mainly measure it with value at risk. It's the most common approach. I showed you Goldman Sachs, they use value at risk. Bank of America, JP Morgan, UTSA uses value at risk. They just don't call it that. So it's a pretty common approach. I don't know about Valero or HEB. They may not. It tends to be more of a financial firm. Your mitigation is almost always correlation. What that means is if we're going to do 10 things and they're risky, we want to make sure they don't all blow up at the same time. So that's what we mean by correlation. Does correlation work? I think it's a really, really weak risk tool, but it's the number one risk tool in finance. So what's a good asset that can help you in a crisis? Well, gold. Gold tends to do well in a crisis because people want something that's, a real asset that they can store away under the mattress and protect them. Has a low correlation. How did it do in 2022 when the markets crashed? Did terrible. So it didn't work. Long treasuries, high quality, and when you have a crisis, interest rates fall, the long treasuries rally. That's great. Good protection. How did they do in 2022? Terrible. They crashed. So what did well in 2022? Oil is about the only thing we had that you could have invested in. The whole world was crashing. Why? Because inflation is a horrible, horrible event. You would think gold would have done well in 2022. Because gold, you would think gold would do well with inflation, but gold didn't do well because the dollar appreciated and gold doesn't like a strong dollar. Although I think this year we've seen the dollar do well and gold do well. So it kind of destroys my whole argument. I'm not sure why gold is doing well this year. I haven't looked at it a little bit here. Gold is messing with us. It's like playing with our minds here because it's really not behaving correctly. It's down today 2.3%, but then so is the stock market. Yeah, I mean, look at what gold has done this year. And if you look at the dollar, I'll do it against the euro. Yeah, you see how much the dollar has strengthened. Well, let me do 1 year. Where's December? See how much the dollar has strengthened this year. So this is euro. So how many euros does it take to buy it? How many euros to get? Well, anyway, it's strengthened because the euro is coming down. So how many dollars? I hate currencies, but so the dollar strengthened this year. Gold doing it. So it's just a bizarre year this year. It's tough to find assets that do well. You can buy insurance. How do you buy insurance in the investment markets? You do options. We're talking about options in my investment class. I'm a big option fan. I did a lot of options at UTSA. So yeah, it's pretty cool. I love filling out my mom's broker account to do options. They ask, you have any experience? I said, Mom, you've done like $3 billion in options. Just trust me. And I put it down for her so we can get full access to options. They're really powerful. So gold doesn't work all that well in certain times when you want it to. Long treasuries work well unless inflation's a problem. So long treasuries would have helped you a lot in the 2008 crisis. They were up like 60%. That would have been good protection when everything else was crashing. In 2022, it didn't work at all. So I'm going to skip through to the next risk because I think we've talked about that. Credit risk. Have any of y'all interviewed for a credit? I know some of y'all sent the Victory Capital. That's a credit shop. So Victory Capital is mainly fixed income. So remember paper one. Anybody remember the template? Short-term viability had two things. Any remembrance? Well, debt, solvency, and liquidity, and then long-term had two things. Turnover and margin. Don't forget everything in the class. Turnover and margin. Well, you did that analysis. That works for stocks. The exact same thing works for bonds. Credit analysts, stock analysts, they do the exact same analysis. They're just focusing on different things. So if you want to be a credit analyst, you would do essentially what you did on paper one. If you want to be a stock analyst, you do essentially what we did on paper one. It's the same analysis to try to understand the firm. So credit risk is that someone owes you money and they go bankrupt and they default, or they don't even have to go bankrupt. So, was it? Oh, I can't remember, Argentina or Venezuela. There was one president got elected in some country and they could pay their debt. They just decided they didn't want to. They said, you know what, we're just not going to pay it. We just don't like the bond market. That's great, right? For the first time you try that. The next time you need to borrow money, it gets a little tricky because they may not want to lend you money. So you might shut yourself out. Credit ratings, we talked about those earlier. So you have S&P and Moody's. Altman Z, I'm not a big fan of that, but you can get the Altman Z, or like the Bloomberg has a really, really good ratio. That's really good. Credit ratings tell you the probability of default, because AAAs rarely default. Triple Bs default about 5% of the time, you know, so they do give you some pretty good numbers. How do you mitigate this? Risk limits. So you say you can't have more than 3% in one company, can't have more than 20% in one industry, those type of things. I had to write these for USAA, and our CEO, I kept going back to him. He kept saying, no, that's too high. That's too high. I need to be safer. And he said, go back and rework your model. I didn't have a model. I was just writing a number down. And I finally said, okay, Bob, you gotta just tell me a number, because you want to be 3%, 2%. What's your risk limit? He finally picked a number, which was really, really, really low. Our portfolio guys, they were mad at me. It wasn't my choice, but they were mad. It's like, wow, that's really low. They were used to buying 50 bonds and suddenly they had to buy 500 bonds. Radically changed their whole process. They were really upset. It was an interesting story there, because before he did that, our number one exposure was a company in Houston that you may have heard of. Anybody heard of Enron? That was our number one exposure. After he did that, Enron went off the charts. We went from several $100 million exposure to just a few $1 million. And the bond guys were calling me and saying, maybe he's smarter than we thought he was. So he saved us a lot of money. I don't even know if he even knew that. Covenants can protect you some, but you have to be careful, because, you know, firms can do some really strange things. There is something, have y'all heard of it, the credit default swap? So credit default swap, you pay money, and if the bond defaults, they bail you out. So it's a credit default swap. I've never done a credit default swap, but they're out there. The interesting thing about them is they have spreads. So if a bond's riskier, its credit default spread increases. So let me give you a little trick that you should take with you, because this is really quite powerful. So let's say you're worried about, well, if someone was worried about Walgreens Boot Island, and you need to monitor them. So what could you do? There's several things you could do. You could do the analysis, your first paper. You could look at their credit spreads. So what's the bond market? So if they're risky, what's going to happen to your credit spreads? If something bad happens, their credit spreads are going to jump up. You could look at their credit ratings, right? If S&P or Moody's is downgrading, I saw S&P was, or one of them was downgrading some country, forget which one. You could look at the credit ratings and the outlook. S&P, Moody's, they don't necessarily change the rating. They can just say the outlook is negative. So they may be single A rated, but they say it's negative, so they may downgrade them. You can look at credit default swap spreads. You can certainly look at that. If they jump up, that's telling you me unusual that CDS spreads and credit spreads wouldn't move together, but they could. They're two different investors, two different markets. So it's possible. You can look at the stock price. If something bad happens to a firm, what's the stock price going to have to do? So what's been going on with Tesla? They went from hating them to loving them all in what, about a few days? Let's do 6 months. So they've hated them, hated them, hated them, hated them, hated them. What they've done the last few days? That's a pretty big rise, isn't it? From 140 bucks to 180 bucks in just a few days. What did Tesla do? Why did the market hate them back here? Because they're doing robo taxis and all this, their sales are falling, all this, and then they say we're going to sell cheaper cars, and something happened in China. I don't know the thing in China, what that means. I can't manage people in China are buying a lot of Teslas, given that China companies are building much cheaper EVs, but maybe it's possible. Anyway, in a few days, the stock market is telling you something that's going on with this firm. And if you watch that, it gives you an early warning sign. What else could you look at? You could look at option premiums. Option premiums, so put options are bearish. What that means is if you buy a put, you win if the stock price falls. If a put option price jumps up, that means the market's worried about this firm. You could set up, if your boss asks you to monitor a firm, let's say you got, Walgreens has contracts with corporations. So you may be in the HR department of a firm or in a management team, and they're worried about Walgreens. Your boss says you need to monitor them. You could do what we did in paper one. You could get their credit spreads. You'd have to get that from Bloomberg. You can get their credit ratings. That you can usually Google and find out, hopefully, but you can get that from Bloomberg as well. This you can get from Bloomberg. Stock price, you can get that from Yahoo Finance. Option premiums, guess what? You can get that from Yahoo. Did y'all know Yahoo Finance has options? So if you're looking at Tesla, there's their options right there. You might go out 3 months. And what you're looking to see is, especially those that are near where the current price is, that they jump a bunch or fall a bunch, especially on the puts. These are calls, but if you look at the puts down below, put prices are up. Tesla must have had a bad day today. Something's going on. Let's see. Yeah, down 5%. The option market will tell you that before the stock market tells you. So you can look and see why, because if they're wrong, they lose a lot of money because they're levered. I'd have options that have been up like 40,000% over 3 days. They don't move 5%. They move massive amounts. And so these people, these investors have a much more skin in the game. And so they react much more quickly. But you could actually set up for your boss this entire template and just monitor it daily. See one of them jump, it's telling you someone out there is seeing something. You want to go check and see what's going on. So it's a pretty good list. I can't think of anything else you might look up other than just obviously news. Just watch the news, but that, and Bloomberg's pretty good at that. So that's the other problem. What if you don't have Bloomberg? You don't have Bloomberg, a lot of this data won't be available. Bloomberg is the #1 tool for the fixed income side for credit analysts. They use Bloomberg even more than the stock side. The stock side tends to use FactSet. Could you get your boss to buy a Bloomberg machine? It's $3,000 a month. Might be a little steep for an entry-level employee. If you're working for Victory Capital, what do? You just use their Bloomberg, right? You may even have one on your own desk. If you work at UTSA, you'd be surprised that the CFO might have a Bloomberg machine. Accountants, we got accounting majors in here. Like accounting majors use Bloomberg all the time for pricing. Because in accounting, someone in the accounting department may need to actually price an option. Because I own the options at UTSA, the accountants had to put that into our financial statements. They use Bloomberg to go price them. So don't assume just because you're not in a bank or an insurance company that they don't have Bloomberg, because they might have it somewhere. The accounting department might have it. You just got to find it. At UTSA, we had Bloomberg machines just in common areas with the password just taped onto the machine, so anybody could stop by and get stuff. I'm sure there are people doing it for personal reasons, which was not allowed, but who's going to know? You go back and say, hey, what are you working on? Oh, something for my boss. And they mean their wife or husband, but yeah. All right, so investment markets tell you a lot about risk. The key here is skin in the game. The best early warning system is someone who loses a lot of money. If something goes wrong, those are the best people to listen to. So anyway, set these things up. You could walk into a firm and immediately set up something pretty sophisticated just from using that list right there. All right, operational risk won't talk too much about, but there's a lot of things that have gone wrong historically where firms just have bad controls. So if you're an auditor or if you're an accountant, you're going to spend a lot of time on internal controls, how you control from theft, employees that are just messing things up, system failures. I don't know if y'all heard about the bats. This was so strange. I was teaching a class at Texas A&M. I don't teach there anymore. But I start the class, in the middle of the class, S&P, the markets just fell like 10%. And during the class, they came back 10%. If I'd been sitting at a Bloomberg museum, I would have been doing some trades because that would have been an opportunity. Instead, I leave class and I look and I go, wait, there's got to be a typo here. What happened? So I missed all of that during class. That was pretty frustrating. If I'd been at USAA, Michael would have called and I would have run back to my desk. You know, even with meetings, it was pretty cool. Meetings with CEOs, we had the authority just to leave the meet. And we could have done it, you know, if we just needed to call our spouse, we could have done it and pretend like it was a trade because he just assumed if we had a run, it was because we had to do a big trade. So if that had happened, he would call us, we were at a run, try to make some trade. So that was something, what happened? Just some software package messed up and it caused the markets to just go crazy. They nosedived and they came right back. How do things like that happen? Well, that's what the auditors, how many of y'all want to be auditors? Or anyone here? We have some accounting majors. Kind of an auditor. I like auditing better than other parts of accounting because they are USA's auditors, very, very impressive. This is a big part of what they do is making sure this firm doesn't go under. Barings Bank is a good example. So Peyton, if you want to be an auditor, you should read this book. This is an auditor's gift, maybe for birthday or whatever holidays. It's called Rogue Trader. Why did Barings Bank fail? Well, this guy, supposedly the book was written from his standpoint, so it may be a little pro Nick Gleason, but his argument was one of his employees made a trade and it messed up, and so they just covered for it with some bad accounting and everything came back, so it was fine. And then it happened again, so they did it again. And the next time it didn't quite work out and it kept snowballing and getting bigger and bigger. And at one point, he had a $300 and something million bank account at Citibank that didn't exist. So he said, I have $300 million at Citibank and it wasn't there. What would an auditor do? Something called confirmation. What do you do? Call the bank and say, hey, do you actually have $300 million here? That would have been pretty obvious, right? And the whole thing would have been shut down. What happened? Well, Barings Bank best auditor went and met with Nick Gleason. He was like, I'm done for. She had a reputation for being, you know, just knowing her stuff. Right when she walks into his office, she gets called back to the home office and her understudy, we thought Nick Gleason was the greatest guy in the world, the smartest guy in the whole company. He takes her place and he's just sitting there praising Nick Gleason and doesn't catch anything. They could have stopped it there. It would have saved the bank. So just basic auditing. He saw a $300 million account and didn't pick up the phone and ask if the money was even there. That's pretty bad auditing. So that's pretty good. You know, there's other things, just Exxon spilling oil, 9/11, those kind of things. The internal audit function is far more important today because of Sarbanes-Oxley and these new rules, probably even Dodd-Frank. You're asking your accounting department to be really responsible for risk in a firm. Some of y'all are in management, hiring, human resources. If you're interested in human resources, I encourage you to read Google's book on hiring. I thought it was really pretty interesting. Why does Google spend so much time hiring people? It seems like overkill, but their argument is we'd rather spend 3 months hiring a good person than spend a couple of days and get a really bad person because it's really hard to get rid of a bad employee. Reputational risk, bad press, how do you manage that? Lawsuits, you know, how do you manage all of this? That's the procedural side. Most firms say they're doing this, but most of them, it's just like they hope for the best. you know, it's tough. You see big risks like this all the time. I will say, I think I showed this in my risk management class, since we're talking about risk. I don't know where I put it though. No, it was in here. Nope, it's not in there. Ah, I had this, and where did I do with it? Oh, that's so frustrating. Had a really great chart I could have shown you. Let's see if it's in here. No, ah, man, what did I do with it? I could have shown you something so cool. Oh well, not in there. Let me try one more place just in case, because I think it's an important concept, but one last. Oh, I'm so frustrated. All right, but I can't show it to you. So I just mentioned that the stock market will tell you a lot about risk. So a few years ago, United Airlines got the headlines for dragging this guy off the plane. I don't know if y'all saw that. Very, very negative, hit the news. You think, oh, this is the end of United Airlines. Everybody's saying, I'm never fly with them again. You watch the stock market for that year, or to show you that year, you would not be able to tell where that happened. The stock market just did that. Hardly even notice. Walmart got in trouble for bribe allegations in Mexico. You look at that year, you could see it. The market dropped by 10%, but it came back pretty quickly. So the stock market is usually a pretty good indication if something's a big deal or not. For United, they say it wasn't that big of a deal. Probably to me, the most impressive one was the Challenger disaster, which was before your time. I still remember that. But after the Challenger disaster, it took NASA a long time to figure out which firm was the most culpable, who really messed up the most. And they finally came out and they figured it out. It was one firm that did some bolt or something that messed up. If you go back and look at the stock market, the firm that was ultimately found to be at fault, their stock price fell the most after the challenge. It's like the stock market figured it out immediately, and it took NASA months to figure it out. It's pretty amazing. It's a pretty famous case. And so these type of big risk, was Exxon Valdez a big deal? You can look at their stock price, you can look at their option prices, you can see what are the people invested in these, because who knows these firms better than anybody else? It's the stock and bond investors that are following these companies, especially a bond investor, right? Because if something goes wrong, they lose all of their money. So yeah, here's a quote from British Petroleum. They spill a lot of oil in our Gulf. And I found this article where they were explaining what went wrong. And here's all their excuses: aging infrastructure, cutting costs, not paying attention, not really having true risk management, just kind of going through the motions, ignoring warning signs, putting profits before safety. So I'm reading this article that I found and said, oh man, I forgot I had this article. This is interesting. And then after reading the article, I looked at the date, and the date of the article was before their oil spill. This was their article about how they messed up on something else before that. And they're saying we fixed it all. So how good is management or risk management? They're not really all that good at it. This quote I like: we only address risk adequately in the middle of a crisis. So how do you measure this? There's really almost no way to measure operational risk. But one thing you can do when you interview for questions and interviews, I would bring up risk management, that you want to work for a firm that has a good risk culture, that, you know, they're worried about these things. You want to work for a firm that if you see something, you can raise it and you don't have to worry about losing your job. But all right. That is, I don't, the working capital. Well, we got a lot of notes left and we're not gonna be able to finish everything. So what should you know on working capital? So what is working capital? You did it on paper one. What's your most important working capital? Net working capital requirement. Anybody remember that formula?
Cash or use of cash.
Yeah, so what were the biggest uses of cash? Inventory, accounts receivable. What's your biggest source?
Payable.
Accounts payables, right? So what is working capital management? It's reducing inventories, reducing receivables, increasing payables. That's essentially what it is. So how do you do that? You're trying to collect faster. Use just-in-time inventory. So those of you that are management majors, is a big part of your job. You'll probably take a course on this, how to manage that. I've never had a course on that. And I've never worked at a firm that had major inventories. Anyway, your prepaid expenses, you can't really manage that too well because your vendors are going to make you pay in advance. And your accounts payable, can you pay as late as possible? You really can't do much. You know, you're going to pay your employees when you pay them. You're not going to say, hey, we'll pay you a week later going forward. That's not going to work too well. But we did talk about unearned revenue, which is a great one. You know, airlines, they get your money before you fly, and that's a great resource to them. So that's how you manage these things. You could, as a management major, come in and add incredible value to your firm by managing the inventory better than your peers. If you can find ways to manage that. How good is Walmart at this versus Costco? Who do you think is better, Costco or Walmart? So Walmart has a major warehouse on I-35, right? They've all seen that. That's a pretty big building. I don't know how many square feet it is, but it looks several 100,000 square feet. I'd love to go inside that building. Wouldn't you love to just see the process? If I were a management major and I was working for Walmart, I would say, can I go and spend a week in that building? Wouldn't you just want to walk around, or an Amazon? Any of y'all been in an Amazon factory? How efficient is that? Is it pretty organized or is it chaos?
My sister works at a fulfillment center, and it's really impressive. There's like 5 floors, and there's a lot of AI involved, a lot of stuff.
There's a lot of robotics or
Yeah.
not? Yeah. I've seen some of the issues with robotics, like the employees are like bumping into them and they're having some problem with robots recognizing that they're in someone's way. But yeah, you could almost, could they replace that entire thing just with robots, do you think, in the future?
I mean, they have an entire floor just for robots.
Yeah.
So
I mean, I mean, you see so many complaints about that job. I don't know how bad it is. Does she like it, or is it kind of,
she's a manager there, and she does like it.
did she start as management or she work?
Yeah. No, she started.
Okay, yeah, it's, so you could add tremendous value there, right? I mean, that operation looks radically different today than just probably 5 years ago. I mean, it's amazing. I'd love to see the Walmart, what they're actually doing. So if you're a management major, that's what you got to do. You got to beg your boss, hey, can I go watch this process? So if you're at a Walmart and you're waiting for all these shipments to come in, you want to know how that warehouse works. Your mind needs to be able to see that, oh man, I'm short on this. And you know how this process works. You want to learn that. That's how you add value. So that's the place you can add value. These others is a little tougher because there's not a whole lot you can do with these others without really upsetting somebody else. All right. Cash management, we won't talk too much about, but your goal is to make sure you don't have idle cash sitting around. Try to invest it as well as possible. This part has changed so much because when I grew up, it was all about managing float. But float doesn't really exist anymore. If you go to Walmart and give them or HEB and give them a check, they're almost going to clear it instantaneously. I mean, there is no float. I mean, everything's been sped up because they just use the meter line on your check, or if you use a debit card, that comes every account immediately, doesn't it? I mean, how long does it take for Zelle to get something to you? It's almost moment, you know, you email someone, hey, can you send it by Zelle, and beep, it's like, oh, there it is. I mean, it's really fast. So this has changed a bunch. At USAA, this was a huge deal. We used to spend millions trying to manage that. Now it's really shrunk as an issue. So how do you learn this? Well, there's something called the Treasury Management Association. So this is a recommendation I would make. I did treasury management for 7 years. It was 1/4 of my job. And so I got this designation. And that's what I recommend you do. Anytime you're in a job, get the designation for that job. So I started off in life insurance. I got the FLMI, got the CLU. I went to treasury management. I got the CPA and the CMA because I'm an accountant. And then I did treasury management, got that credential. Then I went on the investment side, got the CFA. So anytime I went into a new position, I found out what was the certification for that. If you work in banking, get that certification. If you're a credit analyst, get that certification. And there's actually a really good certification today. There it is, FMVA. Have any of y'all looked into this? This would set you apart, no question, on an interview. If you're finance or accounting, it would be huge. I'm not sure how difficult it is. I love this organization. If I were a finance major, I'd be on their site daily. I mean, it is amazing what these people have. But this is one of the things they do. So the reason I'm confident, I've talked to one person who did get it, and she said it was really, really quite helpful for her. I didn't get a sense of how difficult it was. But their whole website is just amazing. The resources, this guy here with my haircut, I mean, he has so many training videos on Capital IQ, on Excel, on whatever. It's just all over the place. So this is a great resource to teach yourself. And then they do have some certifications that you can do. And they do a great job. I don't know who this organization is or how they make money. They probably make quite a bit of money from their certification. I don't know how much this thing costs. You can see. Oh man, that's cheap. I mean, the CFA is like thousands of dollars. The actual exams is what? Your entire net worth for several years. I mean, some of these things are pretty expensive. This one's pretty cheap. If you get something like this, you'll be off the charts at huge advantage in interviews, no question. So could you do this in a summer? I don't know. You'd have to look into it. If you are interested in doing it, I'll work with you. We might even get you some scholarship money or anything, but yeah, I think this would be incredibly valuable. Accounting or finance, if you're, marketing probably wouldn't be as useful. But that's what you got to do. So I went into the job doing treasury management. I got the certification. Treasury management is pretty simple, but with a lot of jargon. So I had to learn all the jargon because they use terms no one else uses. It's finance, but it's finance with different jargon. So why do you have cash? So you have cash because you need to pay your employees. Are you holding it for risk reasons? Are you holding it for opportunities? But you don't want to hold a lot of cash. Now, that was real true 3 years ago when cash was paying zero. Now cash is actually paying pretty well. I'm working with 3 charities that I'm managing their cash for them because suddenly it makes a difference. And my broker makes it so easy for me to buy treasuries, although I saw an article that's saying treasury supply is going to be cut pretty dramatically here. But and they're all this one charity, I could probably make them $50,000 and their loss this year is 90,000. So I say, hey, I can cut your loss in half by doing something really, really simple. So I wrote it all up for them. So today investing cash makes some sense. You can make a lot more money investing cash than you could in the past, but you got to manage it. You got to know what you're doing. And I do what's called laddered portfolio. Have y'all heard of that before? So what I'm doing with one charity is we can invest about $150,000, which isn't much, but she's worried about paying her bills. So $150,000, I take it, I buy by 6, that's 25,000. So she has 25,000 mature in the beginning of the month, 25 at the end of the month over the next 3 months. And before every maturity, I'll call her and say, hey, I got 25,000 maturing. Do you need it? Nope, I'm fine. I'll reinvest it. If she needs it, I take the money out. So, and I'm using treasuries. I don't use CDs. This is one trick to talk about. Why do I like treasuries better? For 2 reasons. They have higher interest rates, so I'll make more money. But the second thing is if you buy a CD, certificate of deposit, and you change your mind, you need your money back, they're going to charge you a huge penalty. If you buy a treasury and you change your mind, you just sell the treasury and you got your money. It would cost you almost nothing, a few dollars. So I do like treasuries more. If CDs were paying 5% and treasuries paying 4.5%, I might go to the CD. But right now, treasuries are paying 5.4% and CDs are paying like 5.1% or even 4.7%. Yeah, I'm going to do that, but just ladder. You see how that laddered works? I just get it, and once they ladder out, you just reinvest them. It's really, really simple. I use Schwab. I'm a big fan of Schwab. Really works. So you're just trying to get the max return you can get, but making sure you have liquidity when you need it. So those mature, it works, it's really, really simple to do. We're not going to cover all of these. Bank lines, small companies tend to rely heavily on banks. So if you're working for a firm, you might check in, what do you do when you need to borrow money? They say we use bank lines. Which bank do you use? Why do you use that bank? You'd be shocked. Some firms, I'm working with one charity right now. I was looking on their investment side and I say, why do you use this investment? Well, one of our board members, her daughter does that, so we gave them the money. It's like, yeah, that doesn't sound like good scrutiny. And asked, well, what are they charging you? Oh, we're not really sure. And so we said, well, let's call them. So they called them and they said, they're not really sure either. So you hired this firm, you don't know how much you're paying them. So they've just now fired that firm and they're hiring another one. But it's like, how can you hire someone and not know? So, you know, you might find it working for some smaller business, they're just using something because one of the board members 10 years ago, that was their bank. But you got to walk carefully, right? You don't go in and say, hey, let's change everything. But you ask your boss, hey, would you mind for me to learn this business if we did an analysis of this relationship? You know, see what your boss says, feel them out, be careful. The firm I'm helping right now is a charity. They had Edward Jones, which I'm not a big, sorry if any of you are Edward Jones people. I'm not a big fan because they just charge so much and don't really do much for them. They're really a smaller investor type of firm, and this is a pretty big portfolio. And so, you know, just helping them out to understand what are you looking for, what are you paying for, what do you need out of this relationship, and what's the biggest thing people do? It's called inertia. Have y'all heard of that? I don't know how to spell it. What's wrong with inertia? Just keep doing what you've always done. Why? Because it's less work. Why do they hire young people out of college? Because you're gung-ho, you have energy, you can handle these type of projects, right? That's what they're after, but you got to ask for them. So be paying attention. It's like, who's our bank line? Oh, Frost Bank. Frost Bank. Well, I wouldn't think of them because that's what this one charity I was working with. They were using Frost Bank. I said, you don't use Frost for your brokerage. They're terrible at brokerage. They may be okay on, and they're really good commercial bank. They're a terrible broker. You just ask, well, you know, I've heard, or I'm going to call my professor at UTSA, see if there's a firm we may be thinking about, you know, start filling those things out and asking questions. You can add tremendous value because there are a lot of firms, even larger firms have just not thought about these things in years. They just don't want to mess with it. You can walk in and be the hero. Debt markets for larger firms use commercial paper. That's a big deal. If your firm does that, you want to try to figure that out and go ask them about that. How do they do that? If you're interning this summer with a larger firm, you know, these kind of questions, you should have a list of questions. So like I talked about WAC, weighted average cost of capital. How do we do that? If you're working for a large firm that you know is borrowing money, say, hey, can I meet the person who does your commercial paper program? I want to learn, I want to see about your backup lines. I want to know how you, what your dealer banks are, what your credit rating, you know, go meet with those. Those are the highest ranked finance people in the corporation. And as an intern, you know, maybe it means you have to work a few extra hours overtime, but who cares? You're there to absorb as much as you can. And you may be in a city where you can't do much anyway, right? You're there kind of stuck in another city. You might as well go meet with these people. So this would be a great place to go see, hey, what it may have nothing to do with your intern, but a good opportunity to go talk to some really sophisticated people in finance, see what they're doing, learn these kind of things. Managing receivables, that's not my forte. I work for an insurance company. Insurance companies don't have receivables. Because what happens if you don't pay your auto insurance premium? Do they send the collection agent out after you? What do? They just cancel your insurance. So it's like, they hope you pay them, but if you don't, there's nothing they can do. You just lose your insurance. So I don't know much about this, but if you're you're in the management side, yeah, you got to figure out who are your customers. Are they paying you? You're gonna have to do the aging schedules. Have y'all done aging schedules? 90 day late, 60 days late, 30 days late, you figure out who's going to pay you back, those kind of things. So your goal is to collect as fast as you can. I don't even think this part even exists anymore. So there was a time where this was a big deal. I worked heavily at USA at this. USA on a Monday might get 400,000 checks, people paying their policies, and USA would process them. And I discovered, I mean, I wasn't trying to be a mean person, but I discovered if they started their process at midnight instead of 2 a.m., we could cut an entire day afloat. And I was just mentioning it. I wasn't recommending it. And the lady who ran the apartment said they had my picture as a dartboard. And I was like, I was just mentioning that, but they actually liked it. I mean, they were joking with the dartboard, but they actually got a better shift differential because they came in at midnight. So it actually made them more money. But yeah, I just, if you can get to the bank an hour earlier, you'll get your checks deposited today instead of tomorrow. That's the kind of analysis you do that you can add thousands of dollars of benefit by doing that. So but this is just not true. People still, well, how many checks do y'all mail? Do any of y'all never mail a check? Yeah, some of y'all mail some checks. What would be CPS? That's electric, right? Your phone bill, that's electric. What are you mailing a check to? So there's not too much you do checks much anymore. Have y'all been at HEB and the person in front of you is writing a check? Don't you feel like just screaming? It's like it's the 21st century, right? But yeah, you don't want to be. It's probably a 70-year-old person, right? There are some people that just like, I don't like this new technology. I don't trust it. Which is safer, electronic or check? So checks are really dangerous. And why are they dangerous? Your name, your address, your phone number, your banking account information, your bank account number is all on that check. So yeah, so I've discovered y'all don't take business law. Is that true? Do y'all have business law? Yeah, y'all are really missing out. So you need to take a class on the Uniform Commercial Code. There's some good courses out there that teach it. It's extremely important to understand the banking system. What happens if someone forges a check? What if someone uses your credit card illegally? What if someone does a direct deposit illegally? I mean, takes your money out of your account illegally? The rules are different between checks and credit cards and debits. Their rules are different. They're all similar in that you're at risk if you don't monitor your account on a monthly basis carefully, but the rules do differ. And it's important to understand these. So yeah, you really should take a business law class. If you can find one online, you should. It's pretty important. So there's a lot of issues with the system, but the world has changed so dramatically. Inventory management, I don't know much about that, but you'll probably take one of these classes if you're a management major. Have any of y'all had this yet? Total order quantity, economic order quantity. That sound familiar? Who's our management majors? I can't remember. There's a few of y'all in here. So it's an important part of your job if your firm has inventories. If they don't have inventories, then it's not going to be a big part of your job. But if I were working at HEB or Walmart or wherever, I would be doing supply chain management. I would just beg my boss, even if it's overtime, can I go watch that process? Who's in charge of that? That's the most important thing they do. So firms that do have a lot of inventory, this is a huge part of their business. All right, y'all can read through the inflation. Y'all get this, when do you take money in banking? Or is that just finance, right? Next semester? Yeah, I don't know who teaches that. It'd be great if you could take it from an economist, but I don't know who teaches. I think it might be finance professors who are fine, but yeah, money making is pretty important right now because of what the Fed's doing. But understanding why is the yield curve normally upward sloping? What is that? And there's theories behind that. You as a finance major should know that. Understanding inflation. Inflation is not inflation. So there's so many measures. You got CPI, you got PPI, you got the core inflation deflator, you got a GDP deflator. and they're all over the place. The core CPE deflator came out this last week and it was 3.7%, and it was only 2% the month before. That was shocking to the market. What's the difference in that number? Well, it depends on how you do shelter. One of them shelters like 30%, the other one shelters like 10%. It depends on how you change, how you adjust for people's buying habits. So if banana prices go up, how quickly do people switch to apples? CPI doesn't switch as fast as the deflator does. If airfare to New York goes up, how quickly do people switch to flying to Orlando? Pretty quickly, but CPI doesn't do it that quickly. So CPI tends to lag. And so understanding that's pretty important. So you know which inflation. So which inflation number does the Fed look at? PCE deflator. That's the one they watch, but that's the one that's least put into the media. So the one that's the most important one is the one headlines. The headlines put CPI, but they don't put this number, but this is probably the most important number. So you'd want to know that number. So that would be important. We won't talk through those things. Finance majors, I encourage you to learn how to bootstrap the yield curve. I've got a video that shows you how to do that. If you want to learn how to do that, email me and I'll send you the link. Bootstrapping the yield curve is a way to use the interest rate market to predict interest rates. And it's really quite powerful, really quite effective. And you should know it, not to pick on the accountants, but one day I was sitting at my desk in my office and the phone rings. I pick it up. I haven't told you all this story before, but I still remember it. I pick it up. It's the CEO of USAA, and he's upset because he's in a room with a bunch of accountants and none of them know how to bootstrap the yield curve. And so he's, Ron, can you teach them? I knew it because they covered it on the CFA exam, so I was real comfortable with it. But he said I'm in a room with a bunch of finance people, but I knew he was in a room with a bunch of accountants. And accounting doesn't, if you're an accounting major, I would learn how to bootstrap the yield curve as well. It's an incredibly powerful tool and it's really simple. Have any of y'all heard that before? Have you heard of the forward curve? Does that sound familiar? So the forward curve, bootstrapping yield curve is saying the bond market is telling you what they think interest rates will be 5 years from now, 10 years from now. That's pretty powerful. The bond market's telling you what they think inflation is going to be 5 years from now. Not only are they telling you that, but if you disagree with them, you can bet against them. And you can actually make money. If they tell you they think the 5-year treasury is going to be 6% in 5 years, and you think it's going to be higher or lower, you can do a trade today and take advantage. It's a really, really cool thing. So this is the forward curve. Bootstrapping is my term, but I do think people use it. The forward curve is derived from this information called bootstrapping. So if you don't know how to bootstrap the yield curve, let me know. I'll send you the videos. You can teach yourself in about 20 minutes how to do it. If I were an actuary major, I'd learn how to do it too. It's pretty powerful. So we're not going to do currency. Oh, I hate currency. My worst day at USAA was currency. My brain doesn't think currencies. Did I tell you about the sweater I bought in Germany? So I was cold, so I bought this sweater. And the lady helping me, she seemed so happy. And I get home, I was supposed to multiply by 2 with Deutschmarks, but I divided. So I thought I was buying something for like $100, and it was actually $500. That's why she was so happy. Back then, you know, just probably $1,000 a day. So that's me. I manage USA's currency risk. It's kind of hilarious, but I managed it by putting it all in Excel, so it was foolproof, so I couldn't mess up. But I hated currencies, and USA's currency risk was minuscule, but you can read through that. That's essentially international business is US business plus currencies and some government stuff. Any of y'all international business, what do they call it? International business majors or some type. So international business is just business, but currencies and government risk. So here's the Walmart bribing in Mexico. The stock market reacted some to that. All right. So that's a quick through the end. I can kind of say we covered everything. It was a pretty fast covered.